Three unstoppable forces are reshaping the global economy right now, and most investors haven't even noticed. While everyone's still piling into safe plays like SCHD and VYM, a few aggressive funds are quietly delivering returns that make traditional dividend investing look outdated. We're talking 50% plus gains, while dividend ETFs celebrate their usual 4%. If you've ever wondered what real wealth acceleration looks like, this is it. And by the end of this video, you'll see why investors who understand these trends early could be years ahead of everyone else. I'll show you exactly how to position these three thematic ETFs as the growth engine of your portfolio. Here's everything I'll cover in this video. The silver mining ETF that's riding a commodity supercycle most investors are missing. A nuclear energy ETF that's captured the renaissance. Everyone's talking about, but few are investing in. The defense technology ETF that's benefiting from $2.7 trillion in global military spending. How to allocate these growth positions within your broader dividend income strategy. By the end, I'll show you a portfolio allocation that could transform your financial independence timeline from 30 years to potentially 15 years or less. Here's the problem with traditional ETF investing. You're fighting for scraps. While everyone's piling into the same SCHD and VYM plays, chasing that 3 to 4% dividend yield, the real wealth-building opportunities are happening in sectors most investors don't even know exist. You're stuck in the slow lane with dividend stocks that'll take decades to build serious wealth, while thematic growth is creating millionaires in half the time. The biggest mistake I see investors make is treating their entire portfolio like a retirement account when they should be using growth ETFs as their wealth acceleration engine. That's exactly why smart investors are allocating 10 to 20% of their portfolios to thematic ETFs that target the world's biggest trends. I'm talking about SLVP, the iShares MSCI Global Silver and Metals Miners, ETF, NUKZ, the Range Nuclear Renaissance ETF, and SHLD, the Global X Defense Tech ETF. These aren't your grandfather's dividend funds. SHLD has delivered over 71% returns in just 1 year. NUKZ is up over 57% since its inception in early 2024. Even SLVP, despite recent volatility, has generated over 46% returns in the past year. While your SCHD investors are celebrating their steady 10% annual gains, these ETFs are delivering life-changing wealth acceleration. Before we dive into the numbers, ask yourself this: what kind of ETF grows 71% in a year, while the rest of the market is flatlining? That's SHLD, and it's not just a defense fund. It's at the heart of a global arms tech race. Let me show you why. SHLD isn't just another defense fund. And what you're about to hear might change how you think about military ETFs forever. This ETF targets companies benefiting from the explosion in defense technology. We're talking cybersecurity, artificial intelligence, advanced military systems, and next-generation weaponry. With global military spending hitting $2.72 trillion in 2024 and projected to reach $3.4 trillion by 2030, SHLD is positioned at the center of a 5% annual growth trend that shows no signs of slowing. The fund holds 42 companies with $2.4 billion in assets under management. Top holdings include Palantir Technologies, which bridges the gap between big data and defense applications, Rheinmetall AG from Germany, and traditional powerhouses like RTX Corp and Lockheed Martin. But here's what makes SHLD special. It's not just military hardware. This ETF captures the tech revolution in defense, including AI applications, drone technology, and cyber warfare capabilities. The performance speaks for itself. SHLD has delivered 71.10% returns over the past year, with a year-to-date performance of 55.41%. That's not a typo. We're talking about returns that could transform a $10,000 investment into $17,110 in just 12 months. Now let's talk about NUKZ, the Range Nuclear Renaissance ETF. This fund launched in early 2024, right as the world started waking up to nuclear energy as the solution to clean, reliable baseload power. NUKZ doesn't just buy utility companies. It targets the entire nuclear value chain, from uranium mining to advanced reactor technology to nuclear fuel production. The fund's top holding is Constellation Energy Corp., followed by Cameco Corp., the world's largest publicly traded uranium company. But NUKZ also gives you exposure to next-generation companies like NuScale Power, which is developing small modular reactors, and Oklo Inc., which is working on advanced reactor designs. This isn't your grandfather's nuclear industry. These companies are building the technology that could power the world for the next century. NUKZ has delivered 57.01% returns since its inception, with year-to-date gains of 28.15%. The fund manages $276 million in assets across 50 holdings, giving you diversified exposure to the nuclear renaissance without having to pick individual winners. And if this breakdown is helping you rethink your portfolio, hit the like button and subscribe so you don't miss the next deep dive into future-focused ETF strategies. We break it all down with real data, no fluff. Finally, there's SLVP, and while most investors are scared off by volatility, this one might be hiding the biggest long-term opportunity of the three. While silver and precious metals have been volatile lately, SLVP represents a contrarian opportunity that sophisticated investors are starting to recognize. This ETF targets companies primarily engaged in silver exploration and metals mining, with heavy exposure to North American miners. SLVP holds 30 companies with top positions in Pan American Silver Corp, Industrias Panoles, and Hecla Mining. The fund has delivered 46.37% returns over the past year and an incredible 111.88% over 5 years. Yes, it's volatile. The fund has a standard deviation of 37.96%, but that volatility cuts both ways, creating opportunities for patient growth investors. So how do you take advantage of these explosive trends without blowing up your portfolio? I'll show you exactly how to build an exposure without risking it all. This is where smart allocation meets life-changing upside. For a balanced approach, I recommend allocating 15 to 20% of your total portfolio to these three themes, with a specific breakdown depending on your risk tolerance and market outlook. A conservative approach might be 6% SHLD, 4% NUKZ, and 5% SLVP. This gives you exposure to all three megatrends while keeping your risk manageable. But here's where it gets interesting. If you're willing to take on more growth risk for potentially life-changing returns, you could increase that allocation to 25 to 30% of your portfolio. An aggressive allocation might look like 12% SHLD, 8% NUKZ, and 10% SLVP. The key is understanding that these ETFs serve a different purpose than your SCHD or VYM holdings. While those dividend stocks provide steady income and stability, these thematic plays are your wealth acceleration engine. They're designed to capture the explosive growth that happens when massive global trends converge with technological innovation. Now, you might be wondering about timing. Should you dollar cost average into these positions or make lump sum investments? For thematic ETFs with this level of volatility, I strongly recommend dollar cost averaging over 6 to 12 months. This smooths out the inevitable ups and downs while ensuring you're building positions during both strength and weakness. Here's the hook I promised earlier. Stick around because I'm about to show you exactly what these allocations could mean for your long-term wealth building. The numbers might surprise you. Let me walk you through a specific example using our friend Harry, who's 35 years old and serious about accelerating his path to financial independence. Harry has a $100,000 portfolio that's currently 80% in traditional dividend ETFs like SCHD and VYM, generating about $3,200 in annual dividend income. Harry decides to reallocate 20% of his portfolio, that's $20,000, into our three thematic ETFs. He puts $8,000 into SHLD, $6,000 into NUKZ, and $6,000 into SLVP. The remaining $80,000 stays in his core dividend income positions. Now let's talk results. And even though these ETFs have exploded recently, I'm going to keep the projections conservative. For SHLD, I'm assuming just 15% annual returns, far below its recent 71%, but realistic given steady growth in defense budgets. NUKZ gets 18%, reflecting the nuclear renaissance, but factoring in slow-moving infrastructure. And SLVP? I'll peg it at 12%, considering the natural ups and downs of commodity cycles. So what happens to Harry's $20,000 allocation? SHLD. $8,000 grows to $16,094 in 5 years, $32,383 in 10, and $130,869 in 20 NUKZ. $6,000 grows to $13,770, $31,591, and $172,317. SLVP. $6,000 turns into $10,573, $18,630, and $57,946. Together, that's $361,132 from just $20,000 over 20 years, an 18x return. And here's the kicker. While those positions are compounding fast, his remaining $80,000 in SCHD and VYM keeps growing steadily at 9%. That adds another $448,000. So Harry's total after 20 years? $809,132 versus around $500,000 had he stuck with dividend ETFs alone. That's the power of blending stability with acceleration. These returns look aggressive, and they are. That's the trade-off with thematic ETFs. High upside, but higher risk. SHLD is concentrated in large defense contractors, and its exposure to weapons may raise ESG concerns. Yet with rising global tensions, defense tech remains a strong long-term growth trend. NUKZ faces regulatory and political hurdles. Public opinion on nuclear is mixed, and infrastructure takes years to build. Still, it's gaining rare bipartisan support due to climate and energy security demands. SLVP is the most volatile of the three, with silver prices driven by everything from industrial demand to Fed policy. But demand in solar, tech, and electrification gives it structural strength. To manage risk, keep your allocation to 15 to 25%. That way, even if these plays underperform, your core dividend portfolio provides stability. But if they perform even half as projected, you could massively outperform traditional income strategies without betting the farm. Want to play this smarter than 99% of retail investors? Let's talk about what the pros are doing and how you can apply it without needing a hedge fund background. Here's how power users are squeezing even more upside without taking on crazy risk. These are advanced plays, but I'll keep it simple. You might also consider rebalancing frequency. Unlike buy and hold dividend investing, thematic ETFs benefit from periodic rebalancing to lock in gains and maintain target allocations. I recommend quarterly reviews with annual rebalancing, unless one position moves more than 50% away from your target allocation. Tax considerations are crucial too. These growth-oriented ETFs generate most of their returns through capital appreciation rather than dividend income. That means you control when to realize gains, potentially allowing you to optimize your tax situation in ways that dividend stocks don't permit. Geographic diversification is another factor. While NUKZ and SHLD have significant U.S. exposure, SLVP provides international diversification through Canadian and Mexican mining companies. This geographic spread helps reduce single-country risk while maintaining exposure to your chosen themes. The future belongs to investors who act before trends go mainstream. While others debate SCHD versus VYM, you could be building exposure to three powerful forces driving explosive growth. These aren't wild bets. They're strategic plays with real momentum. A 15 to 25% allocation could massively accelerate your path to financial independence without giving up dividend stability. If this helped, like and subscribe, and drop a comment. Are you sticking with dividends or adding some firepower?